I'd like to introduce David Harrison. David is Charter Hall's Managing Director and Group CEO with over 37 years of global property market experience. David has been instrumental in overseeing the significant growth of the Charter Hall Group since CHC first listed on the ASX in 2005. Thanks for joining us, David.
You're welcome.
Why don't we start bigger picture, the macro level? It's been a volatile 12 months. We've seen significant movements in inflation, interest rates, bond yields, a little bit of global economic uncertainty. What do you think it means for the Australian commercial property sector going forward?
Look, it's a complex environment we've been in, but what I would say is there's two elements to the dividends or distributions that you get out of property. One is your income line and one is your expense line, which is driven by debt costs. The reality is that commercial property in all sectors, even office, much maligned, has been continuing to produce solid income growth across all of our portfolios. Yes, interest expense has gone up, whether you have a residential mortgage or you've got debt on commercial property. The rapid rise in interest rates has meant the interest expense has grown, and that's eaten into the growth in the income line. We're seeing rates stabilise, we're seeing inflation stabilise. Ironically, despite all of the suggestions from economists that the US may well see inflation fall and interest rates fall before Australia, I'm probably in the camp that we may well see peak rates and then rates falling from central banks at about the same time in Australia as the US. But what I would say is that fundamentally, the characteristics of all sectors in the commercial property area, particularly for high quality property, are still in good shape. We'll talk about office, but you know, what I'd say to people is remember 80% of all the vacancy factors that you see reported sit in 20% of the office stock, predominantly older stock in poor locations. In the prime markets, occupancy is holding up. Charter Hall still has the highest office occupancy of any major peer in Australia at about 97%. Some of our peers are as low as 87%, and obviously the average vacancy across all the major markets is around sort of 10 or 11%. It is like picking stocks in the stock market. There are winners and losers, and you really need to stay focused and patient on good quality real estate with a growing income stream.
So look, moving on to valuations, it's arguably one of the toughest years since the GFC over the last 12 months. The valuations have impacted the performance of the funds. You sit across over 1,600 assets, see everything across the group. What, for our audience, if you could explain the key drivers behind what's really been happening around these valuation movements?
Well, I think it's pretty simple, and I have the same discussion with our big super funds and global pension funds. When interest rates fall, as they did from about 2013, 2014, the cap rate or the capitalisation rate on all asset classes, but and including commercial property, the cap rates fall and they drive valuation growth above the embedded income growth. At times when you have a rapid rise in bond yields and interest rates, as we've seen in the last 18 months, cap rates rise faster than the income growth, and that means your valuations come down. What I would say to people is that these things fluctuate, but what's important with high quality property is keep it high occupancy, make sure you can get inbuilt rental reviews, whether they're fixed reviews or CPI linked, so that your income growth can outlast this volatile movement in interest expense. So valuations, yes, have come down. All the major property companies have reported valuation falls, but I'd also remind people that valuations also rose quite appreciably from 2017 to virtually peak June 22, and then as interest rates have risen, well, cap rates have risen. But equally, we're probably getting to the top of the cap rate cycle, which basically means, as interest rates and bond yields fall, there's a reasonable expectation based on 40 years of history that cap rates might fall as well. Now, when cap rates stabilise, you're going to get valuation growth in line with your rental growth. If you also have what we saw from 2015 through to 2022, cap rates falling and income growth going up, you're going to have outsized valuation growth. So I think people need to stay focused on the long term when you're investing in property, and particularly focus on high quality tenant covenants that don't go broke. Yep. We've got the largest office exposure from office tenant customers across our $30 billion office portfolio. About 36% of all of our office assets are leased to government. A very high proportion are leased to high quality blue chip corporate tenants, as well as that government exposure. So the risk of default is very low in all of our property portfolios, and therefore the sustainability of that income, occupancy and rental growth gives us some cause to be optimistic about the medium term.
And we just went through the COVID period, lockdowns, and as a group there was little to no tenancy defaults in arguably the toughest economic conditions that we have had in 15 years. And the next question, David, maybe a little bit cheeky, and it is something that myself and the team do get asked, and hopefully you can answer it, but do you think we're at the bottom, or are we getting closer to the bottom of the valuation cycle?
Oh, there's no doubt. Just like the world thinks we're more or less at peak rates, and there's very few economists predicting a rise in official cash rates, and the whole speculation in the capital markets is when central banks will start reducing interest rates. My sense is broadly we're at the top of the cycle in terms of cap rates. I'd remind a lot of people that we've had a pretty significant increase in cap rates across most sectors. It'll be very property specific. So if you've got risk and you've got a lower occupancy rate and higher vacancy rate, there may be some differential impacts on those valuations. As a general comment, I would say we're certainly seeing evidence of a bottoming of valuations for CPI linked assets. Most of our portfolio, we're the largest owner of triple net assets in the country across all sectors. Most of our CPI linked assets have triple net leases, which means the tenant pays for all outgoings and all capital or capex. So my view is that depending on particular sectors, we're pretty close to sort of trough valuations. And as I said, if cap rates even stay flat where they are, you have this inbuilt income growth that will provide some rise in valuations over time.
Okay, that's good information and gives a bit of clarity. And look, obviously, as David mentioned, things can and do change, but we have seen some material movements in cap rates. And yeah, we're very transparent in the valuation process at Charter Hall.
Can I just add, Steve? Gearing's not always a dirty word. The reason why the net tangible assets or unit prices of funds rose steeply when interest rates fell and cap rates fell is that the asset value growth was amplified by 30% gearing or whatever the gearing is. Equally, when we get to a trough cycle, because that gearing has amplified net devaluations, as assets rise, it amplifies the growth in net tangible assets and your unit prices. One thing that is very important to us is maintaining strong rental cash flow at the underlying property level. And that will help us the most to drive valuation growth, even if cap rates stabilise and don't change.
Okay, excellent. And I guess moving back towards the long term, you present a lot of PCA, external events in the paper. You have been quoted on numerous times around the shifts to automation, the risks of older assets compared to more modern property stock, and where you think the best opportunities are. Is that something you still hold? And How are we leaning into that?
Well, it depends on the sectors. Like, there's no doubt in my mind we are seeing a bifurcation of tenant demand in the office sector. Tenants, employers, gradually either mandating or encouraging their people to work in the office more, whereas during the pandemic there was a lot of work from home. Many of our major tenants, both government and corporate, are saying they want the very best modern properties because they're going to provide the best ESG credentials and accommodation, and the location is also going to provide retail and hospitality amenity for their staff when they come into the office. So I think the bifurcation of tenant demand for office is real, and I think we're going to see that continue. You only have to look at our major office developments. We're building another Chifley Tower right in the core of Sydney CBD. It's almost 60% pre-leased, and we've only just started construction. 60 King William Street, another example, virtually pre-leased before completion. We're at about 70% on a project in Brisbane, which has still got another year under construction. Another project we just finished before Christmas, the new head office of Australia Post in Melbourne, was 95% pre-committed prior to completion. So there's evidence of this demand I'm talking about for modern assets. Charter Hall has got the youngest average age of office buildings across any of the major managers in the country. And part of our focus is whether we're buying stabilised assets or we're building new stock, we want to keep them modernised. So even if we have existing assets, we're constantly looking to ensure the lobbies and the amenity of those facilities are first rate so that we can maintain that sector leading occupancy that we talked about earlier. In industrial, there's no doubt we are seeing major corporates shift to purpose-built new facilities where they can invest large amounts of capital in automation. Very difficult to do that in a 30 or 40-year-old asset. Now, at the moment, there's virtually zero vacancy in industrial, so everyone's, riding the wave of rental growth. Our view is that unless there's a very high land value, you want to recycle into the more modern facilities, build your own, and also ensure that your stabilised assets are fit for purpose. I think it's different in shopping centres and other parts of the retail sector, which by their nature are constantly going through maintenance and capital upgrades. So the age of a shopping centre is less relevant than it is in office.
Location, catchment.
Location, major arterials, catchment, these are all important things. But even our Bunnings portfolios, are generally the latest Bunnings specification. They're not the old BBC hardware house conversion. So we own in our whole Bunnings portfolio the modern Bunnings model that Bunnings has built themselves, rather than we're inheriting a 30-year-old BBC hardware house.
And look, I'll just pick up something you mentioned around working from home. It wouldn't be an update, and it'd be remiss of me having you here if I don't ask a little bit more. Are you seeing our big tenants wanting to come back and get in their stuff back? Because the narrative around working from home and the presence in the office has definitely been changing over the last 12 months.
Oh, there's no doubt. You've had recent examples like major US companies even telling their staff, if you live too far away from work, you need to move and be closer to work because we expect you to be in the office. Ross McEwen, the CEO of National Australia Bank, was quoted in the newspaper this week that when they moved their people into our new 60 King William Street premium grade building in Adelaide, they doubled the staff attendance in the NAB offices. So I think there's plenty of evidence of that happening. The government sector's probably been a little slower. However, I think that's starting to change as well. And there's no doubt that, as unemployment starts creeping up, I think, generally people will be far more focused on aligning with what their employers want. And I think we'll see an escalation in working in the office. I think a lot of organisations like Charter Hall will maintain flex strategies, but at the end of the day, the evidence is stark that productivity is much better when your people are working in an office environment and collaborating and mentoring the young people that need to be mentored rather than trying to do it on a Zoom call.
And periods of change, and you touched on at the start around the rapid increase in interest rates, volatility creates opportunities and risks. We've talked about some of the risks already around valuations. To balance out the discussion, where do you see the opportunities?
Well, I think if I go through the history of Charter Hall since we listed in 2005, our greatest period of growth has been after correction cycles, whether it's the sort of GFC or even the onset of COVID. And I see this as an opportunity where if we're out acquiring assets or even developing them, the yields and the total returns are better than they would have been a year and a half ago. Yep. We are seeing pockets of value add opportunities. Development is very difficult. You know, construction cost inflation is well documented. The required returns we and others want on development have risen in line with bond yields. So what we are seeing is tenants who want new office space, for example, are going to need to be paying pretty significant premiums to existing rents to get the very best in new accommodation. That's particularly the case in industrial. If you want a new industrial warehouse, distribution facility or even manufacturing facility built for you, you're going to have to pay what we call an economic rent, which is the rent required to justify the cost of development. So I see lots of different opportunities. I also see as bond yields peak and start to fall, the re-emergence of strong demand for long lease blue chip tenant covenants. It's become a little counterintuitive in the industrial market, but through normal cycles, people will pay more money for modern long lease blue chip tenant covenant assets than they will for short lease risky older assets. So that dynamic is about to change during the course of 24 and beyond. And I also think that we at Charter Hall have been pretty good on both picking sectors and macro themes that are going to drive outsized returns, but also avoiding the dogs or the pitfalls. And there's plenty of examples of sectors that we have stayed away from and avoided pretty serious sort of valuation decline over the last decade or two. So I think we'll continue to do that, and we'll continue to curate opportunities and present them to our investors.
Okay, fantastic. And I guess as head of our business, you have more exposure to some of the largest wholesale global investors, not just in Australia, but North America, Asia, Europe. What are you hearing from them in terms of how they see the Australian property market now, but probably more interestingly going forward and where they're looking to invest?
So I think you've got to start with, if you're a global investor, you're looking at Asia as a geography, just like you'd look at North America or Europe. Asia as a geography, the only two real core markets that are seen as core, transparent, relatively low risk are Australia and Japan. There's a lot of volatility in other parts of Asia, so a lot of core capital is wanting to allocate to Asia generally. The population growth in Asia is massively outpacing North America and particularly Europe over the next 50 years, and therefore people see Australia as being a great transparent proxy for investing in that population growth story in Asia. I think equally, because of the stability of our markets and we don't have a lot of speculative development that creates lots of oversupply that has occurred in other parts of the world, we're seen as a reasonably safe haven for global capital. But, you know, the reality is Australia's out there competing for capital with every other major commercial market. So, you know, because of, you know, cap rates and discount rates rising, you know, we are now screening as an attractive place. We will see a lot more global capital looking to invest in Australia. I think we'll continue to see a lot of Australian super fund money invest in the domestic market. A big chunk of the last 12 months of transactions in industrial have been funded by Aussie super funds, who are massively underweight industrial as an allocation compared to their global peers. So I see that continuing. So I think from both an Australian super fund perspective and a global pension fund or global sovereign perspective, Australia is going to continue to be an attractive destination, and in many ways will probably get an outsized allocation relative to Australia's population compared to the rest of Asia or the rest of the world.
And it makes sense. I always say at these things, demographics are your friend in real estate, and Australia's population growth is performing strongly. And there's many surveys, ANREV, Survey Global Investors, and a lot of the Australian markets are consistently ranked 1, 2, 3, whether it's Aussie industrial, residential, and so on. David, we've gone into a bit of detail. I appreciate your time, but it'd be good for our audience. We'll finish with a couple of quick questions.
Is this like 60 seconds with
60
Sterlo?
seconds with Sterlo, very quick,
Okay.
punchy. Best performing sector you think in the medium term?
I think logistics, industrial and logistics will continue to outperform in the medium term. It's got a virtual zero vacancy, strong underlying demand, not a lot of new supply, and the multiplier effect from population growth, which creates outsized demand for warehouse space, I think is a very good macro tailwind.
Okay, I'll conflict you here. We've got listed, we've got unlisted. What's your best way to get property exposure?
It's like my 4 children, I love them all. So look, you play the listed market in an opportunistic sense. At the moment, you can buy good quality REITs at steep discounts to underlying net tangible assets, but with that comes volatility, and you're looking at the price every day. So you've got to decide whether you've got an appetite for volatility when you invest in listed REITs, but there's no doubt, we've grown our business investing in REITs to nearly 500 million now. I'd say we're in the top 10 active investors in the Australian REIT sector, and we'll continue to make those opportunities available to all of our investors. Equally, on the unlisted side, you get less volatility, and provided you're investing in good quality assets and with the sort of characteristics I've talked about, I think there's a strong motivation, and let's face it, the pricing now is quite attractive when you sort of look at IRR, income yields plus capital growth prospectively over the next 5 to 10 years versus putting your cash in the bank. I think that's going to be attractive, and I think it will get more attractive as term deposits and cash rates start falling. But both in listed and unlisted, you need to be careful about who you're investing with, the management team of either a REIT or you, in the unlisted world, who your manager is, and also the quality of the assets that they're investing and the underlying tenant covenants. I keep stressing that is going to be something that is going to hold really high quality portfolios apart from some not so great portfolios.
Okay, one word, just one, how you would summarise your expectations for the year ahead.
Trough.
Okay, good, you heard it here first. And finally, last question for today, number one tip for property investors.
Be patient. Property is a long-term investment. If you want short-term investment, go and buy tech stocks or mining companies. Property is a long-term investment. The reason why the big super funds and the big pension funds invest in property is not just for the absolute returns, but also the lower volatility than the stock market. So I think you need to be patient, accept that you'll continue to get pretty good income returns and some capital growth. There'll be some volatility because assets go up and down, but over the long term, I think you've got to stay patient.
Okay, I think that last answer in particular is very relevant for our audience around the time frames you need to be looking at when you are considering unlisted property investments. So David, thank you very much. Great to have you here today. Thank you, David.